Hello everyone, welcome to another episode of To The Point. Today's topic of discussion is India's Forex Reserves Rise. First of all, let's see why it is in the news. India's foreign exchange reserves rose by 4.698 billion US dollars to reach 702.966 billion US dollars in the week ending 12th September 2025, according to the Reserve Bank of India's latest weekly statistical supplement. RBI Governor Sanjay Malhotra also confirmed that India's reserves are now sufficient to cover 11 months of imports. Now let's discuss what are foreign exchange reserves. Foreign exchange reserves are assets held on reserve by a central bank in foreign currencies. It can include banknotes, deposits, bonds, treasury bills, and other government securities. Following the 1990 to 91 economic crisis, Siataga Rangarajan and Y. Reddy Committee recommended maintaining forex reserves to cover 12 months of imports. Components. India's forex reserve include foreign currency assets predominantly composed of major global currencies like the US dollar, euro, and Japanese yen. Gold reserves. Gold has long been valued as a key reserve asset, offering both stability and universal acceptance. Special drawing rights, SDR, created by the International Monetary Fund, are reserve assets that supplement member countries' official reserves. Reserve position with IMF. It is a portion of the required quota of currency each member country must provide to the IMF. Now let's talk about what is the role of forex reserves in economic stability. Economic buffer. Reserves help countries manage downturns, stabilize currency, and maintain investor trust. Trade equilibrium. Reserves enable countries to address trade imbalances when imports exceed exports. Monetary strategy. Reserves allow central banks to control currency value, manage inflation, and implement monetary policies. Fulfilling external obligations. Sufficient reserves help countries meet external debt, boosting international credibility. Exchange rate management. Central banks use reserves to intervene in the foreign exchange market, ensuring competitiveness and reducing volatility. Liquidity provision. Reserves ensure a country can meet financial obligations like debt and imports during crises. Now lastly, moving on to challenges ahead. Global oil price volatility may pressure reserves due to high import bills, capital outflows. Global interest rate changes could trigger sudden withdrawals. Exchange rate pressures. Managing the rupee against a strong US dollar requires careful balancing. Dependence on short-term flows. High reliance on portfolio investments increases vulnerability. Now is the time for practice question. Consider the following statements about India's foreign exchange reserves. 1. Gold reserves form the largest component of India's forex reserves. 2. India's forex reserves are managed solely by the Ministry of Finance, with no involvement from the Reserve Bank of India. Which of the statements given above is or are correct? A. 1 only. B. 2 only. C. Both 1 and 2. D. Neither 1 nor 2 2. Send the answer of this question in the comment section. Thanks for watching. For more informative content, like, share and subscribe, and do not forget to press the bell icon to get the notifications. For more informative content, like, share and subscribe, and do not forget to press the bell icon to get the notifications.